contract. Today, I will cover what is Murabahah is, overview Murabahah contract, modus operandi, the current issue article based on discussion and implication. First is Islamic finance is based on Quran and As-Sunnah. It prohibits riba, qarar, and maisir. It also ensures that all transactions are fair, transparent, and Sharia compliant. Murabahah is a cost plus financing contract. In this contract, the seller discloses the asset cost and profit margin before selling it to the customer. Payment can be made immediately or through installment. It is commonly used in Malaysia for home, vehicle, and financial. Overview of Murabahah contract. Murabahah is one of most widely used contract in Islamic finance, especially in Islamic banking. It is sale based on contract where the seller and asset to buyer at the original cost plus an agreed profit margin. The cost price and profit must be disclosed clearly to ensure transparency. In Islamic banking, Murabahah is commonly used to finance the purchase of house, vehicles, business equipment, and other assets. Instead of providing a cash loan, the bank first purchases the asset requested by the customer. The bank then sells the asset to the customer at a predetermined selling price, which includes the bank profits. The customer can make payment through installment or at an agreed future date. To comply with Sharia principle, the asset must be halal, valuable, and clearly identified. The bank must also own the asset before selling it to the customer. In addition, the transaction must be free from riba, qarar, and any prohibited elements. The validity of Murabahah contract depends on several essential elements, namely the seller, the buyer, the asset, and agreed selling price, and the offer and acceptance or sikah. Due to the simple structure, transparency, and lower risk, Murabahah remains one of the most popular financing methods offered by the Islamic financial institution today. Next is modus operandi of Murabahah. The Murabahah contract works through a simple process. First, the customer select an asset such as car, house, or equipment and apply for financing from an Islamic bank. Second, the bank purchase the asset from the supplier and take ownership of it. Third, the bank sells the asset to the customer at a price that includes the original cost plus an agreed profit margin. This selling price is fixed and agreed by both parties at the beginning of the contract. Finally, the customer pays the amount either through monthly installment or according to an agreed payment schedule until the full payment is settled. Current issue of Murabahah contract. Murabahah faces several current issues in practice. First, in terms of Sharia compliance, there are concerns that banks may not fully own or take a real risk of the asset before selling it to the customer. In some cases, especially tawarruk, transactions are done very quickly, which reduce real asset possessions and make it less like junior trade. The application of cut and daman also sometimes unclear, so scholar and regulator continue to monitor it. Second is from a market practice perspective. Murabahah profit rates are often linked to conventional interest based on benchmark. Because of this, it is looked like similar to conventional loans. Many of banks also focus more on documentation and legal procedure rather than real trading activities. So, it is sometimes seen as a market-driven product. Finally, in terms of digital finance, the use of online platform makes transactions faster but raises concern about Sharia compliance, especially on ownership transfer, automation of reduced human checking, which may weaken compliance control. In addition, enforcement and recovery process become more complex in digital system. Next is article-based discussion. The name of the article is Al-Khanatir Article 403. Commodity Murabahah is widely used in Malaysia for Islamic financing and liquidity purpose. The contract works where the bank buy commodity through a platform like Bursa Suq Al-Sila, then sell them to the customer at a deferred price with profit. The customer later sells the commodity to get cash. The article explained that this structure is practical and widely used in Islamic banking. However, there are several Sharia concerns. One issue of it is whether it is a real trade or just structured transaction. There are also concerns about true ownership and risk transfer. Scholars also differ in opinions. Some accept it is a modern banking needs, while others say it is too close to conventional loans. Overall, the article highlights concern about overuse of commodity Murabahah and suggests the need stronger Sharia governance and better transparency. Next, implication. The issue in commodity Murabahah brings several important implications to Islamic finance. Firstly, it may affect customer confidence if people feel the contract is too similar to conventional loans, which can weaken trust in Islamic banking. Secondly, it can create reputational risk for Islamic financial institutions as they may seen as not fully reflecting to Sharia principle. Third, regulator may introduce strict guidelines on ownership, possessions, and transaction process to ensure proper Sharia compliance. Finally, differences among scholars may continue leading to variation in how the contract is applied across different countries. For the conclusion, Murabahah is widely used in Islamic finance because it is simple, practical, and suitable for financing assets like house, car, and personal needs. However, there are several issues from a Sharia perspective. There are concerns about whether banks truly own and take a risk of asset before selling it, especially in fast tawarruk transactions. In market practice, profit rates are often linked to the conventional interest benchmark, and banks focus more on documentation than real trading activities. Finally, digital finance creates new challenge as automation can reduce Sharia compliance check and make ownership transfer more complicated.